Why does receiving a fresh $500 cash payout into your investment account feel like absolute triumph when your entire portfolio actually dropped by $1,200? The human brain routinely falls victim to a dangerous cognitive bias known as mental accounting, treating regular dividend checks as entirely free bonus money. But while retail investors celebrate these short-term cash dopamine hits, sophisticated institutional funds quietly ignore yield metrics to focus exclusively on total return parameters. Today, we dismantle the hidden friction of forced taxable events and systemic equity dilution that silently erodes your wealth velocity before you even notice. To understand this financial illusion, we must examine the mathematical certainty of ex-dividend adjustments occurring on the global stock market every single day. When a corporation distributes cash to its shareholders, the stock exchange automatically marks down the asset value by the exact amount of that payout. You are not capturing brand new economic value. You are merely witnessing a mandatory, forced liquidation of corporate capital that immediately reduces company equity. Think of your high-yield portfolio as a leaky ATM machine that extracts money directly from your own principal account balance to hand it back. To make matters worse, the moment that cash leaves the corporate umbrella, the government immediately intercepts between 15% and 30% for taxes. This phenomenon, known as dividend tax drag, ensures that a massive portion of your hard-earned wealth velocity is permanently sacrificed to fiscal friction. While a standard low-turnover index fund allows your capital to compound silently without friction, high-yield instruments trigger continuous, inefficient tax liabilities. Furthermore, companies paying extreme yields often starve their own internal operations, sacrificing long-term market expansion and cutting-edge research to satisfy short-term income demands. This structural capital depreciation means the core value of your investment engine is quietly decaying while you celebrate those deceptive monthly cash deposits. Your underlying principal gets systematically diluted, forcing you to reinvest diminished post-tax cash just to maintain your original purchasing power baseline. Let us break down a real-world example of how capitalistic triggers systematically exploit this exact psychological need for immediate cash gratification. Marketing algorithms target retail investors with dazzling 10% or 12% yield advertisements, masking the underlying decay of the parent enterprise. Unwitting consumers step straight into these yield deserts, completely unaware that their total return profile is falling vastly behind the broader economic market. Every single forced distribution acts as an artificial barrier to the unstoppable momentum of uninterrupted, multi-decade compounding interest. When you look past the immediate dopamine loop of regular payouts, the mathematical reality of long-term wealth accumulation becomes staggeringly obvious. Tax friction and capital erosion behave exactly like a heavy iron anchor dragging down what should be a frictionless, accelerating vehicle of wealth. To truly maximize your ultimate net worth, your operational philosophy must shift entirely away from short-term cash flows toward total value optimization. The sophisticated investor knows that an arbitrary payout schedule is merely an accounting mechanism that regularly triggers unnecessary wealth extraction. Upgrading your financial intelligence means looking completely past short-term cash dopamine loops to protect your actual lifetime net worth over extended horizons. Subscribe to Economecha right now to systematically dismantle the hidden capitalistic codes and psychological traps that dictate your economic future. Next, we will analyze a rigorous 20-year backtest contrasting a standard market index against high-yield alternatives to reveal the precise mathematical damage. To uncover the ultimate cost of this psychological illusion, we must analyze a rigorous 20-year backtest, starting with an initial $100,000 investment. On one side, a dedicated high-yield portfolio focusing entirely on dividend aristocrats struggles to maintain structural pace against broader market vectors. On the other side, a standard, low-turnover broad market index fund channels all internal corporate earnings directly back into compounding asset appreciation. Every single year, the high-yield model triggers mandatory distribution events, forcing investors to surrender vital wealth velocity directly to fiscal authorities. Over 2 decades, this constant dividend tax drag systematically cuts the final wealth velocity of the income portfolio by more than 40%. While the total return investor enjoys uninterrupted, non-taxable compounding growth, the high-yield enthusiast is left with a severely fractured capital base. The backtest exposes a brutal reality where regular payouts are completely offset by the structural capital depreciation of the underlying equity basket. By chasing the immediate gratification of monthly cash deposits, retail investors willingly lock themselves out of millions in ultimate retirement wealth. The fatal mistake lies in failing to see that corporate distributions are not magically added bonuses to your existing net worth statement. Every dividend payment is a forced liquidation that strips cash directly from the company's internal balance sheet, lowering its market value. You are essentially cannibalizing your own primary economic engine, converting an appreciating asset into a taxable liquid event against your will. When a business hands over capital to satisfy yield-hungry retail algorithms, it surrenders its core capacity to fund future disruptive market innovations. Consequently, you end up owning a collection of stagnant, low-growth enterprises that slowly decay while masking their decline behind high distributions. This systemic equity dilution ensures that your purchasing power is quietly eroded, even if your nominal monthly cash flow seems stable. The capitalistic framework is expertly calibrated to exploit your behavioral desire for safety, distracting you from massive long-term opportunity costs. To break free from this wealth-draining cycle, you must immediately implement a strict scientific strategy known as total return calibration. This tactical shift requires you to completely disable arbitrary yield filters and refocus your primary automated parameters on net asset value maximization. By utilizing low-turnover, capital-appreciating equity index baskets, you create a powerful barrier that systematically bypasses annual distribution and tax triggers. Your capital is allowed to compound within the corporate structure entirely frictionless, maximizing the ultimate velocity of your lifetime net worth. If you absolutely require cash flows, you can systematically manufacture your own liquidity by strategically selling minimal shares within tax-advantaged vehicles. This scientific approach ensures that you only trigger liquidations when it serves your personal tax bracket, rather than letting corporate schedules dictate your liabilities. Tomorrow morning, open your personal investment portal, audit your holdings, and ruthlessly eliminate assets that compromise total return for superficial cash payouts. Restructure your foundational automation settings to prioritize long-term equity growth, ensuring your financial engine operates at maximum economic efficiency. True financial independence is not built on the psychological dopamine of regular payouts. It is forged through the mathematical optimization of total wealth accumulation. Take command of your capitalistic destiny today. Dismantle the behavioral traps of consumer capitalism and permanently upgrade your financial intelligence.